out there, I hope that you're doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on time cycles. Buckle up. First of all, I want to pay attention to the following text with you. Time without price means nothing. Price without time also means nothing. But when they align, it yields great precision. Meaning, if you're too focused on purely time, you're ignoring price. If you're too focused on purely price, you're ignoring time. However, when you start ignoring one or the other, what you're actually doing is you're decreasing the probabilities of you being able to make an objective analysis. Why? Because both time as price are the only two objective variables which we can truly deem to be counted within the markets. And therefore, our job is to align them, because when both time as price tell us the same story, we can anticipate with a high degree of confidence that we are likely going to see a specific scenario unfold within the markets. And therefore, blending time and price leads to great precision. Let us take a look at some theory, first of all, when it comes to time cycles. On the screen right here, you can see that I've plotted 3 boxes. Each one of these boxes represents a specific window of time. I refer to these windows of time as time cycles. What is very important to note is that these time cycles have a fixed start and a fixed end that does not change. Meaning, if you're looking at, for example, daily cycles, you're paying attention to the days from midnight to midnight. And therefore, the days of, for example, Monday, all Mondays are going to have the exact same time. All Tuesdays are going to have the exact same time. All Wednesdays are going to have the exact same time forever. The same applies to, for example, if you're paying attention to weekly cycles. If this would be week 1, for example, well, the week begins at the Sunday open and ends at the Friday's close. The same applies to week 2 and the same applies to week 3. This right here will never change, guys. And that's very important that you understand that these time cycles are fixed, meaning they will never be adjusted. Now, when it comes to these time cycles, what's important to note is that each time cycle determines how the next time cycle is going to deliver. Meaning cycle 1 determines how cycle 2 is going to deliver. And cycle 2 determines how cycle 3 is going to deliver. And throughout each new time cycle, we refer back to the previous cycle's delivery. Meaning during cycle 2, we refer back to the cycle's 1's delivery to monitor where the previous cycle high and low formed. And the same, of course, applies to cycle 3 relative to cycle 2. The reason why we pay attention to how the previous cycle delivered is because based upon how the previous cycle delivered, we can anticipate how the current and next cycle are likely going to deliver. So when we pay attention to these cycles, they provide you with an objective roadmap that can guide you throughout navigating the financial markets. This theory applies to all markets. Doesn't matter if you're looking at index futures, it doesn't matter if you're looking at forex, it doesn't matter if you're looking at commodities, it doesn't matter if you're looking at crypto. These time cycles apply in all markets. Does that mean they are clean across all markets? No. However, that means that you need to pick which markets you are interested in. There's a reason why I purely focus on the indices, on the index futures, because right now at the time of this recording, early 2025, they are the cleanest. However, in the future, this might change, and then I might have to adopt what market I'm looking at. When we pay attention to time cycles, each time cycle has its own respective function, meaning it either accumulates, or it manipulates, or it distributes. As the text right here suggests, your focus should be on recognizing manipulation to anticipate distribution. Meaning, these time cycles do not only have a function, but that function is not fixed. Meaning, the time cycles themselves are fixed, however, the function of the time cycle changes. Meaning, they shift. So that means sometimes you are going to see accumulation take place perfectly throughout the first time cycle, manipulation throughout the second, and distribution throughout the third. However, there will be instances in which the accumulation is going to last throughout, for example, the first and second time cycle, then the third cycle will manipulate, and then the fourth cycle is going to distribute. So what is very important to note is that your focus has to be on recognizing the manipulation, because once you're able to recognize the manipulation, you can anticipate the distribution to unfold afterwards. There are two ways to gauge order flow using time cycles. First of all, you can pay attention to the purge and revert. The purge and revert is basically when within a bullish market, we see the market open a new time cycle, drop lower, taking out that previous cycle low, which we have determined by looking back, of course. That sells liquidity gets taken out right here, and we then see the market form a low and it begins reversing to draw towards the opposing side of liquidity, towards the previous cycle high. Why? Because above that previous cycle high, a lot of buy side liquidity has been engineered. Within a bearish scenario, what you will see is the following. What you will see is that the market opens high, takes out the previous cycle high, takes out the buy side liquidity which was resting above this high, and we then see a reversal taking place and the market begins to draw towards the opposing side of liquidity, which is resting below the previous cycle low. This right here is what I absolutely love to see. I like purchase and reverts, and the reason why is because it's inside of this drop lower if bullish that a lot of retail mind traders are going to turn overly bearish, and I'm buying against that. If I'm bearish for the session or day or week, of course, I'm looking for an open high, because it's in this process that a lot of retail minded traders are going to turn overly bullish throughout this final run higher, and that is what we're looking to short against. Because what we're looking for is looking for manipulation to anticipate distribution. Think back to the previous schematic. Another possibility is that when a time cycle with respective high or low gets taken out, that we see continuation taking place. Meaning, when a new time cycle opens up and we're bullish, we're expecting that the market is going to be repriced above the previous cycle high, and then we anticipate that that previous cycle high will function as support and price. If we would be bearish, it would look the opposing, where we would be looking for lower prices and we would be looking for the market to drop below the previous cycle low, and from that moment in time, we anticipate that the previous cycle low is going to function as resistance on price, so that the order flow can continue to be bearish. Now, one thing which I want you to look at when you go into your charts is the following. I want you to look for a very specific algorithmic signature by IPTA. The algorithmic signature which I want you to look for is the following. I want you to look for an imbalance to displace through that previous cycle high or through that previous cycle low. Because it's in that imbalance that you're going to see true support turn resistance or true resistance turn support. That's a key insight. Now I understand that so far you're probably like, all right, this is all fun and games. You explained the theory behind time cycles. You explained how to look at them, how to gauge the order flow. However, you haven't explained yet what the exact timings are. And some of you are now probably like, how do you know this? You're reading my mind. Don't worry, I will get to that in a bit. Here we can see the yearly delivery, and we are constantly going to refer back to the same schematics which I have provided already. Meaning, if we pay attention to the yearly delivery, you can see that January determines how February will deliver. February determines how March will deliver. And throughout each new month, so throughout February, we refer to the high and low of January. Throughout March, we refer to the high and low of February. Now, I didn't want to put the full 12 months in within this schematic, but this logic applies to literally the full 12 months of the year. And therefore, you could also, for example, say, all right, let's put in April, May, June, for example, as an example within these schematics. So be flexible when it comes to the time cycles which you're looking at. But to basically make it more easy for me to explain this concept to you, I've just focused on January to March. When we pay attention to a chart example, you can see that I have, however, outlined different months. And the reason why is because I want to show to you that this theory applies across all months of the year. What you can see right here is that I've highlighted the months of July until November. And what you can see is that throughout the month of July, we saw the market rip lower. It was dropping aggressively towards the downside. We saw a very quick expansion towards the downside. The fact that the month of July was so bearish right here sets the stage for the following. It sets the stage for a high resistance gradient run towards the upside. Why? Because whenever there's a quick run on the left side of the curve, you can anticipate that what will happen is that IPTA is going to go through that from a whipsaw perspective, where it's going to go back and forth, back and forth, back and forth, aka a high resistance gradient run. So what you see is that August opens low, takes out the July low, and then begins to reverse and retrace into the July range. Notice that we see the market open up for the month of September. What happens? Open low, and we see the market run higher. October consolidates, and then November expands higher, drawing towards the July high. Now, the reason why this is a perfect example of these monthly cycles having influence on each other is because based upon how July delivered, you can anticipate how the following months are going to deliver. Meaning you can anticipate that since the higher time frame institutional order flow was still bullish, that first of all, this run lower was manipulation, and therefore you can anticipate continuation higher to unfold later. However, next to that, what you can anticipate is that due to the quickness of this expansion lower, that the months that will follow are going to be high resistance gradient run months. And therefore you can see that there's a lot of back and forth going to reprice above this range, which got established within just a month. And therefore you can see that there was a lot of time required in order for the market to reprice above this range, which got established in just 1 month. When we pay attention to the monthly delivery then, what you can see is that the monthly delivery begins from week 1 and ends by week 4. What you can see is that week 1 determines how week 2 will deliver. Throughout week 2, we refer to the high and low of week 1. Week 2 will determine how week 3 will deliver, meaning throughout week 3, we pay attention to the high and low of week 2. Throughout week 3, we anticipate that we can know how week 4 is going to deliver. Throughout week 4, we pay attention to the high and low of week 3. Now, when we pay attention to the monthly delivery in general, and we pay attention to what news events are given each new month, it is important to note that throughout the first week of each new month, we have the NFP release. And I've discussed this as well within the Predicting Price series. So if you have not watched that series yet, I highly suggest you to watch that. But when it comes to NFP and its importance on the monthly profile is the following. Because NFP is present throughout the first week of each new month, you must understand that this right here sets the stage for the full sequence for the month to come. Meaning week 1 determines how week 2 will deliver. Week 2 determines how week 3 will deliver, etc. And therefore paying attention to how this first week delivers is very important for understanding the full sequence within time. When we pay attention to an example of this, what you can see is that throughout the weeks which I have plotted right here, you can see that the first 2 weeks expanded towards the upside. Notice that the market was in a rush to reprice higher. Week 3 then came, and what we saw take place was that the week opened high, taking out the previous week's high, and we then saw this reversal taking place. Notice how quick and sudden this repricing lower was. Notice that the market forms a new monthly low, and we take out the sell side liquidity of the first week. Now it's in this drop lower right here that you must understand that what's likely going to happen next when a rejection takes place is that we're likely going to see the market retrace back into the range which got established throughout this large expansion lower. So what do you see week 4 do? Week 4 opens low and immediately reprices higher, trading into the range of week 3 right here. And this is how you can see that throughout the first 2 weeks, the idea was established of higher. Week 3 comes, opens high, and begins to roll over, drawing towards sell side liquidity engineered throughout week 1 and week 2. So pay attention to who has been making money, who is now being trapped into believing a certain idea, when is manipulation taking place. Because once you recognize this run higher to be manipulation, you can anticipate the distribution to unfold afterwards. When we pay attention to the weekly delivery within a regular week that begins on Monday, the only reason why I say that a regular week begins on Monday is because when we have a bank holiday on Monday, I would argue that Tuesday is actually the first day to monitor of the week. But in general terms, within a regular week, Monday sets the stage for Tuesday, and on Tuesday we refer to the high and low of Monday. Tuesday then sets the stage for Wednesday, and throughout Wednesday we refer to the high and low of Tuesday. Wednesday sets the stage for Thursday, and throughout Thursday we refer to the high and low of Wednesday, and Thursday sets the stage for Friday, and throughout Friday we refer to the high and low of Thursday. So what you can see is that each new day we pay attention to, okay, how did the previous day deliver? Or how did the previous days deliver? What is the story which is currently being told? Where's the liquidity resting? Because once you're able to frame the proper narrative and you're able to define where the liquidity is resting, what you will be looking for is you will be looking for manipulation into the opposing direction of your anticipated drawn liquidity, and then you can anticipate that distribution will take place afterwards. When we pay attention to a chart example of this then, what you can see is that inside of this week, we open up right here and we drop lower for the week. And when I refer to the opening of the week, I refer to the Sunday open. Monday opens up at 12 a.m. It's the midnight open, guys, New York time. We begin to see the market expand towards the upside. This high forms, and we then see Tuesday open up. Tuesday opens low, and we see the market expand towards the upside. Notice that we see the market consolidate and relatively equal highs get created. A retracement takes place and Wednesday opens up. Wednesday opens low, back into Tuesday's open, and we see the market begin to expand towards the upside. Eventually Thursday opens, and Thursday again opens low, but there isn't really an expansion which takes place afterwards. It's just a consolidation. It's a very slow grind towards the upside, which you can see. However, what has taken place so far since the weekly open? We initially opened up, dropped lower, and then Monday till Thursday, we saw the market grind towards the upside, meaning it was being repriced higher. This right here sets the stage for the following. When Friday opens up and it runs higher, taking out the buy side liquidity resting above the previous day high, the Thursday high, and rejects that high, we can anticipate that a concept which I will teach you later as a delivery profile called Thank God It's Friday is taking place, where the market is drawn towards sell side liquidity, which has been engineered throughout the run higher for the week. Meaning Monday to Thursday, we saw the market run higher, Friday draws towards this engineered sell side liquidity. Engineered sell side liquidity is resting below these lows of Thursday, for example, and below this low right here, because there was still this imbalance which had to be traded into. What does Friday refer to? It refers back to the Wednesday open, as you can see. Now, when it comes to the overall narrative behind the concept of Thank God It's Friday, I want you to understand that it is all about recognizing who has been making money all throughout this week. Are the signs present of a higher time frame reversal taking place, of a weekly high forming? If so, we can anticipate the market is now going to turn around and draw towards sell side liquidity next. Do you see how Monday sets the stage for Tuesday, Tuesday sets the stage for Wednesday, Wednesday set the stage for Thursday, and the fact that Thursday consolidated right here set the stage for open high on Friday? Pay attention to how the previous day delivered to anticipate how the current day will deliver. When we pay attention to the daily delivery then, what you can see is that the daily delivery begins with the Asia session right here and ends with the afternoon session. All the timings which I have provided right here are in New York time. On TradingView, you can change on the bottom right of your charts your time to New York time. And that is something which I suggest you to do to be aligned with what I'm teaching to you. What you can see is that the Asia session begins at 6 p.m. and ends at 2:30 a.m. The London session begins at 2:30 a.m. and ends at 7 a.m. The New York morning session begins at 7 a.m. and ends at 11:30 a.m. And the afternoon session begins at 11:30 a.m. and ends at 4 p.m. Now again, as has been the whole foundation of this lecture, Asia sets the stage for London. Throughout London, we refer to the high and low of Asia. London sets the stage for the New York morning session. Throughout the New York morning session, we refer to the high and low of London. And the New York morning session sets the stage for the afternoon session. Throughout the afternoon session, we pay attention to the high and low of the New York morning session. Now, one thing which is important to note is that even though I have just been mentioning the previous time cycle with respective highs and lows, we also pay attention to the highs and lows of even further time cycles in the past. So throughout the afternoon session, you can be referring to the London high and low, for example. Or throughout the New York morning session, you can be referring to the Asia high and low, for example. Don't forget about those levels. And that is why I suggest you to use the time cycles indicator, which I've provided on the mentorship platform, which helps you significantly with determining where the time-based security pools are. Now, when it comes to the delivery, which you can see in front of you, you can see that when we open up a new week and the market began expanding towards the upside, you can see that the Asia session expanded higher. The London session then came along and we saw the market again expand towards the upside. It was a very slow expansion higher, however it was an expansion higher. The New York morning session then also expanded higher, meaning you can see that AMA right here until AMD is the New York morning session, and the same of course for London A and the London D. We'll get into what the AMD exactly means within these boxes in a bit, but what you can see is that the market again expands towards the upside throughout the New York morning session. So what you see is that both Asia as London expanded higher, but now we also see that the New York morning session also expanded higher. So what you begin to see is that the 3 sessions of the day up until that point all expanded higher. And that sets the stage for a New York afternoon session, which is going to be very messy. Why? Because large ranges turned into small ranges. And therefore, whenever you recognize that the market has been expanding higher, you can anticipate that at one point in time, this is going to basically lead to a consolidation, lead to a tight range. When we pay attention to the London session, it's 90-minute cycles then. What you can see is that the London session begins at 2:30 a.m. and the first 90-minute cycle is between 2:30 a.m. to 4 a.m. This is the accumulation cycle. The second cycle of the London session is from 4 a.m. to 5:30 a.m. and the third cycle is from 5:30 to 7 a.m. I refer to the first cycle as London 1, the second cycle as London 2, and the third cycle as London 3. This is just a terminology thing, guys. And this is how I like to explain to you what I'm seeing within the markets, because you need to understand that what I'm trying to show to you is that there's an objective method of looking at the markets. Notice that I haven't even discussed a break or a value gap or whatever entry pattern you might be using or whatever indicator you might have been using, VWAP or any other like retail concept out there. You need to understand that at the end of the day, there's a framework in play which leads to all those things working. And that framework is what I'm showcasing to you now. This is time. Throughout the previous lecture, I've introduced you to price as well, and that is what we're going to expand upon. These lectures that I'm sharing with you now as the beginning of this 2025 model series are just to introduce you to how I'm going to teach you to look at the markets throughout the remaining part of this series. Now, when we pay attention to the London 90-minute cycles then, what you must understand is that this first 90-minute cycle, London 1, sets the stage for London 2. London 2 then sets the stage for London 3, and throughout each new cycle, we refer to the high and low of the previous cycle, and we monitor the reactions to these levels. However, monitoring the reactions themselves is not enough, because we must recognize manipulation before the reaction by itself actually means anything. So that means we must first of all define what are we looking for. Are we looking for a higher London session or a lower London session? Let's say that we are going to look at a London session in which we're anticipating higher prices. What we're going to look for is we're going to look for a purge of a previous London low. So that means, for example, throughout the second 90-minute cycle, we can look for a purge of the first 90-minute cycle with respective low, followed by a revert towards the high. Please note that the revert towards the high doesn't need to complete within this second 90-minute cycle, because the revert towards the high can also complete throughout the third 90-minute cycle. Within a bearish example, it would be of course the opposing, where we would look for a purge of the 2:30 to 4 a.m., the London 1 high, followed by a revert towards the low. When we pay attention to an example right here, what you can see is that I've plotted the 2:30 to 4 a.m. buy liquidity pool, the high, And next to that, you can see that I've annotated the 2:30 to 4 a.m. South liquidity pool, this row. What you can see is that when we open up at 4 a.m. for the second golden cycle, the 90-minute cycle, what you can see is that we open low and immediately take out the previous 90-minute cycle low. Notice, however, that this did not set up an immediate reversal towards the opposing side of liquidity, towards the high of the previous cycle. Instead, we saw the market run higher, engineer buy side liquidity, and then within this second 90-minute cycle, you can see that there are also 3 boxes which are plotted. These 3 boxes represent 30-minute cycles. Notice that the second 30-minute cycle within this second 90-minute cycle opened and dropped lower, taking out the previous 30-minute cycle low, which already took out the previous 90-minute cycle low. We see a smart money reversal taking place, and then we see the market begin to draw towards the buy side liquidity pool of the previous 90-minute cycle high, this buy side liquidity pool. Notice that the third 90-minute cycle delivers this objective, and we then see the market eventually form the high to draw lower. Now, I understand that if you're completely new, I just went through that way too quick. And your mind is probably spinning now. You're probably like, what did you just discuss? I understand. I promise to you now that if you come back to this lecture in a few months from now, whilst you investigate deeply what I'm outlining to you, you are going to smile by what I just outlined. And you're going to be smiling about the fact this has been hidden underneath your nose in plain sight for all this time. It's time that moves price. Meaning, recognize what the function of the current time cycle is so that you can anticipate what the next movement in price is going to be. Anticipate distribution by recognizing manipulation. That should be like your top note from this lecture so far. When we pay attention to the morning session, its respective 90-minute cycles then, what you can see is that the morning session begins at 7 a.m. and ends at 11:30 a.m. Notice that within this window of time, we can find 3 90-minute cycles. Now, I already know that there are going to be questions about how did you come up with these 90-minute cycles? How did you figure it out? How did you know what these cycles were? My mentor, the Inner Circle trader, has been using these 90-minute cycles for a very long time. And the way I realized that is by the following. My mentor, ICT, he was hiding in plain sight that there were specific elements in time that could provide you with a very objective manner of looking at the markets. Because IPTA is coded to refer to time cycles, but also price cycles. What he mentioned multiple times was that at 8:30 a.m. a new 90-minute cycle begins. So that right there was already the first element of time that provided us with the opportunity to say, okay, well, if at 8:30 a.m. a new 90-minute cycle begins, that means that between 8:30 to 10, there's a 90-minute window of time. Next time cycle is going to be 10 to 11:30. Next cycle is going to be 11:30 to 1, etc. When ICT then came out and mentioned his final silver bullet time, 7 to 8:30 a.m., the full circle was completed. And the reason why was because it's very random, so to say, right? That he has been hinting at 8:30 a.m. as a crucial opening time all this time. And then all of a sudden, his final silver bullet time comes out and it's the 7 to 8:30 a.m. 90-minute cycle. When you then pair this understanding with the understanding of AMD, accumulation, manipulation, and distribution, you begin to understand the true logic behind these time cycles. And when you investigate them, you are going to smile. So what you can see is that 7 to 8:30 a.m. is your first 90-minute cycle. This is what I refer to as AM1. AM1 sets the stage for AM2, the second 90-minute cycle between 8:30 to 10 a.m. Throughout AM2, we refer to the high and low of AM1. AM2 is going to set the stage for AM3, meaning throughout AM3, we can anticipate the delivery which will take place based upon how the previous 90-minute cycle delivered. Throughout AM3, we refer to the high and low of AM2. AM3 lasts from 10 a.m. until 11:30 a.m. When we pay attention to a chart example then, what you can see is that I've annotated the 7 to 8:30 high right here in this box. And next to that, you can see that I've annotated the 7 to 8:30 low. Please note that I've plotted the high and low based upon the boxes. When we pay attention to a chart example then, what you can see is that I have plotted the high and low of the 7 to 8:30 a.m. cycle. This is done automatically by an indicator which I've created, which you can find on the mentorship platform. Notice that the market consolidated throughout AM1. This consolidation sets the stage for how AM2 is going to deliver. Meaning what we will be looking for is we will be looking for the market to run higher, taking out the buy-side liquidity of the previous 90-minute cycle high, the AM1 high. Why? Because we're looking for lower prices, meaning we're anticipating open high for this 90-minute cycle. Notice that the market runs higher throughout 8:30 to 9, the first 30-minute cycle within this second 90-minute cycle of the morning session. We then see a new 30-minute cycle open up, open high at 9 a.m. and the market begins to drop towards the downside. Now what you can see is that I've annotated the full delivery which took place above the previous cycle high in gray. And the reason why is because this right here is where manipulation is taking place. And this right here is where you can see that the market is just basically spending some time before it's allowed to roll over. We see the market drop lower between 9 to 9:30. 9:30 opens up and we initially see the market run higher, trading back above the previous cycle high, but notice that the bodies stay below it. We see the market then expand towards the downside in a very violent way, and when such a quick expansion lower takes place throughout the second 90-minute cycle, the third 90-minute cycle is either going to distribute towards the final objectives or it's going to chop around. When we pay attention to 30-minute cycles then within the morning session, I just wanted to discuss this because I've already mentioned 30-minute cycles prior throughout this lecture. I just want to make sure that you had a visual idea of them as well. Please note that these 30-minute cycles are present within each 90-minute cycle of the morning session, but also of the London session, but also of the New York afternoon session. Now, before we dive into them, I just want to mention to you that you might be wondering, Zeus, why don't you discuss Asia? Look, if you want to trade Asia, yes, you can look for the same time elements to play out. However, the only issue that's present throughout Asia is that Asia sets the stage for the full daily delivery which is going to come. And therefore what you often see throughout Asia is that the delivery is not very clean in that sense. Meaning you can see that it's just very tight ranges usually. You see the market just go back and forth, back and forth. The moments that I'm interested in are the moments which I'm mentioning to you now. That doesn't mean I trade the London to New York afternoon session every single day. I determine what session I'm interested in the day in advance, or maybe even the week in advance when I look at the economic calendar. However, in general, these are the sessions which I want you to focus on, because this is where you're going to see the cleanest algorithmic price action. Why? Because this is when the amount of liquidity within the marketplaces is the highest for the markets which we have interested in. Now, when we pay attention to the morning session then, through the lens of 30-minute cycles, what you can see is that we are looking at the final 90-minute cycle of the morning session, meaning the 90-minute cycle from 10 to 11:30 a.m. Notice that within this 90-minute cycle, we have three 30-minute cycles, meaning 10 to 10:30, 10:30 to 11, and 11 to 11:30. Now, the same concept applies as prior, where you can see that 10 to 10:30 sets the stage for 10:30 to 11, and 10:30 to 11 sets the stage for 11 to 11:30. Now, throughout each new 30-minute cycle, we refer to the high and low of the previous 30-minute cycle in order to gauge the order flow. When we pay attention to a chart example then, what you can see is that this overall green box represents the 90-minute cycle from 10 to 11:30 a.m. Notice that throughout the first 30-minute cycle within this 90-minute cycle, we saw the market drop lower. Notice that I've annotated the high and low of 10 to 10:30. And notice that when 10:30, the second 30-minute cycle opened up, we opened low, taking out the previous 30-minute cycle low, followed by a reversal towards the previous 30-minute cycle high. When does this complete? This completes throughout the third 30-minute cycle, right here. A, M, D. Beautiful, right? Let's pay attention to the afternoon session 90-minute cycles. The afternoon session, its respective 90-minute cycles, begin at 11:30 a.m. and end at 4 p.m. What's very important to note is that the 11:30 a.m. to 1 p.m. 90-minute cycle is called the lunch cycle. Generally speaking, we do not look to trade this 90-minute cycle. There are days in which the lunch cycle will deliver a very volatile moment, and that is whenever there's a trending day and the market is in a rush to get somewhere. That is when you can anticipate that they're going to work through lunch, so to say. However, on your average day-to-day day, you're likely going to see the market just engineer liquidity between 11:30 a.m. to 1 p.m. What this lunch cycle does is that it sets the stage for the delivery which will take place between 1 to 2:30 p.m. So throughout PM2, which is the name of this second 90-minute cycle of the afternoon session, you will refer to the high and low of the lunch cycle. PM2 sets the stage for PM3, PM3 being from 2:30 p.m. to 4 p.m. Throughout this 90-minute cycle, you refer to the high and low of the previous 90-minute cycle to gauge the order flow. Again, each time cycle sets the stage for the next time cycle, and throughout the next 90-minute cycle, you refer to the high and low of the previous 90-minute cycle in order to gauge the order flow. Let us take a look at a chart example. Here you can see the chart that we also discussed on the 30-minute cycle example. However, now it's a bit later. What you can see is that between 11:30 a.m. to 1 p.m. the market consolidated. Notice that I've highlighted the high and low of this first 90-minute cycle of the afternoon session. At 1 p.m. a new 90-minute cycle opens up and we see the market drop towards the downside in a very quick manner. Eventually, after 2 p.m. right here, you see another very quick sudden drop lower taking place. The market forms a low and we then see the market begin to displace towards the upside. 2:30 p.m. opens, open, low, drops into this imbalance. Oh, I discussed a price element there, my bad. And we see the market begin to reprice towards the upside. Notice that there's a lot of consolidation which is taking place right here until the end of day macro, which we're going to discuss later as well throughout specific time lectures. But right here, what you can see is perfect accumulation, manipulation, distribution. And within those distribution cycles, you can see that there's even more distribution which takes place between 3:30 to 4 p.m. Now, with that being said, this lecture comes to an end. I hope that you found it insightful. I hope that you were able to gain a lot of insights on time cycles from it. If you did, be sure to go into your charts and investigate. And I really suggest you to claim this time cycles indicator, because this time cycles indicator helps you out a lot with recognizing what the current 90-minute cycle is doing and what to anticipate from the next. All in all, I believe that time cycles can get understood if you just put in the required time, because it's simply a game of repetition, repetition, repetition. Why? Because you will come to realize that every single day there's a specific playbook which IBTA is following. Over time, your ability to recognize what the playbook for the day will level up, because what will happen is that you're going to refer to past experiences in which you recognize the exact same delivery profile being in play. Understand time cycles, and once you understand time cycles, pay attention to delivery profiles. Delivery profiles are again also going to be discussed in great detail within this 2025 model series. Good luck with your studies. Look forward to catching up with you in the next episode.